So page number 68, problem number 4, page number 69. Okay, problem number 4. Ramya, Kavya, and Divya are partners sharing profits and losses in the ratio of 1:2:1. Please have a look at it. The ratio is different here. 1:2:1. Total is 4. Their balance sheet as on 31/3/2018 was as follows. Look at the asset side. Cash, debtors, stock, furniture, machinery, and building. So cash will go to cash account. Remaining 5 assets go to debit side of realization account. And then creditor liabilities side, creditors, bills payable, bank overdraft will go to credit side of realization account. Reserve fund will go to capital accounts. One is loan. See, one is not a partner. You can see the partner's name, Ramya, Kavya, and Divya. So one is not a partner. So one is loan will be taken again in the realization account along with creditors, bills payable, and bank overdraft. It's not a partner's loan. Vani is an outsider to the business. So it will come along with creditors, bills payable. Next, capitals will go to capital account. On the above date, they decided to dissolve the firm. Assets realized as follows: debtors, stock, building, vehicle which was unrecorded, also realized. So vehicle is not given in the balance sheet, but that also is realized. That is why it is called unrecorded asset realized. Then continue. Next sentence, next line, and machinery realized at book value. So machinery amount is 20,000 is realized. That is the one. Next, information B. Furniture was taken over by Ramya at a valuation of 9,000. So asset taken over. Next, C. Creditors were settled at 10% less. Divya took over Vani's loan. So in adjustment C, we have two entries. One creditors paid, one liability taken over by one of the partner. D. Interest on bank overdraft due rupees 400 was also paid off. Was also means along with bank overdraft, the interest on bank overdraft is also paid. Adjustment or information E, realization expenses amounted to rupees 4,000. So prepare as usual 3 accounts: realization account, partners capital accounts, and cash account. So what is new here is partners loan is not there here. Other than the partners loan is there, that is the new one. So we'll work the problem, then you'll come to know what are all the new things therein. So page number 69, problem number 4, realization account. Format is ready with me. Particulars and 2 amount columns. Getting into the first asset, transfer all the assets to the debit side of realization account. Start from the second asset, that is debtors. To debtors account, 15,000. Stock and furniture, 18,000 and 12,000. To stock account, 18,000. To Furniture account 12,000. Two more assets are there, machinery and building 20,000 and 60,000. So that also will debit it to machinery account 20,000 to buildings account 60,000. So we have transferred all the 5 assets what we had in the balance sheet to the debit side. Now we'll move on to the outside liabilities, which to be transferred to the credit side of realization account, starting from creditors and bills payable 20,000 and 6,000. So by creditors account 20,000, by bills payable account 6,000. Next, as I told you, bank overdraft is also an outside liability, and Vani's loan 5,000 is also an outside liability. We'll transfer both bank overdraft and Vani's loan. It is not in the order. Then also you have to be very careful and check it out. Bank OD account.
Sir, why are we transferring this to?
We are closing the accounts of these. These accounts are closed in the ledger account, what maintained by the business. So we are transferring all those over here. We have done all the problems same, no? Transferring all the outside liabilities
Yes,
to
sir.
credit side to close this
Yes,
account.
sir.
These accounts will get closed. Cash account you prepare, capital accounts you prepare, so we don't transfer those. So whichever account which can be converted into cash, all assets debit side, which have to be paid, liabilities to be paid will be on the credit side. So here profit or loss may arise because when you realize more value for the assets, profit. When you realize less in the assets, loss. Similarly, when you pay more to the liabilities, it's a loss. When you pay less to the liabilities, it's a profit or a gain. So to calculate the profit or loss on realization of assets and payment of liabilities, we are preparing realization account. That is the main objective over here. So in that process, we have these steps 1, 2, 3, 4 like that. So I have taken first step, all transferable assets, sorry, all realizable assets to debit side, all liabilities to be paid is on the credit side. Now I'll move on to the adjustments or information. Assets realized as follows. Remember, in the asset side we have cash. So these assets were sold and money realized or money received by the company, or money received by the business. So it is going to be by cash account. Cash is coming in. Realization account is credit. So we have to write the amounts therein. Debtors and stock. Debtors 13,500. Stock 19,800. So first one, debtors realized 13,500. Second one, stock realized 19,800. Next, buildings 62,000 and vehicle which was unrecorded also realized 4,000. So buildings realized 62,000. And unrecorded vehicle realized 4,000. Next, Machinery realized at book value. So book value means balance sheet value, it is 20,000. So machinery also is converted into cash, 20,000. So first adjustment of first information we have considered and entered. Next is furniture was taken over by Ramya at a valuation of 9,000. So instead of asset is converted into cash, asset is given to partner, partner is the receiver. So debit the partner's account. So Ramya is taking, so Ramya's capital account is debited. By Ramya's means Ramya's account is debited and realization account is credited. That is the entry therein. Ramya's capital account debtor to realization account. Furniture, only one amount, 9,000. So there are step number 3, two possibilities. One, asset is converted into cash. Other one is asset taken over by one of the partners. Next, C, creditors were settled at 10% less. First, we'll take that one. So whichever is paid, any liability, any expense is paid to cash account because cash is going out of the business. The entry will be realization account debtor to cash account. Under cash account, we write all the payments done by the business. Creditors, book value means balance sheet value. You can see here
2,000.
20,000 less 10%. So 2,000 less
18,000.
paid,
18,000.
18,000 is paid. Have a look carefully. Settled at 10% less. You have to be very careful in the exam, more or less, 10% less. Next, Divya took over Vani's loan. So Divya is a partner. So to Divya's capital account. So she took over Vani's loan. So you can see one is a Vani's loan here, 5,000. So take that over here, 5,000. So the entry will be realization account debtor to Divya's capital account, liability taken over. Liability taken over. So remember here, there are 4 liabilities. What you can see here, creditors, bills payable, bank OD and one is loan. So here we have taken one is loan and creditors 2 are done. 2 more are there. Let's see further. Interest on bank OD due 400 was also paid off. So they have not told anything about bank overdraft. But we have to understand bank overdraft is a bank loan to be paid in full. Without that, the business cannot proceed for other payments. So bank OD, then interest on bank overdraft is also paid. So first we have to pay the bank loan, then the bank overdraft. Bank overdraft is paid full amount. Interest on bank OD is 400. That is why it's called also paid off. Next, realization expense amounted to 4,000. So now we have to check, like earlier problems, whether all assets are realized, all liabilities are paid like that. So have a check. Debtors book value, debtors realized. Stock book value, stock realized. Furniture is there. Furniture taken over by one of the partner. Then machinery recorded in full, realized in full. Buildings were there. Buildings are realized. So all 5 assets are realized. Let us check the now liabilities. Creditors were there. Creditors paid 10% less. Bills payable is there. Nothing has been told about bills payable in the problem. Have a look at it. Have they told anything about the bills payable? Check it out.
No, sir.
No.
No, sir.
So we have to pay bills payable in full, even though they have not told anything, because it's an outside liability. Business has to pay. So we'll assume bills payable is paid in full, that is 6,000 rupees paid in full. So nothing is left here. When we are doing the realization, all information we have considered. So let us go for balancing the realization account. For that, let us total the assets first. How much money has been received by the business? You also can check it up. 1,19,300 has come. Next, all liabilities and expense paid, we have to total it. How much has been paid? So 32,400. Next, we have to go for balancing. When you look at that, the credit side looks more. So let us total the credit side first. One lakh 63,300. Let us take the same amount on the debit side also. Then minus all these amounts which is there on the debit side to find the profit or loss.
$900.
900. Okay. $900 we will divide among the partners in the ratio. Ramya, rupees 900 into 1/4. Remember, 1:2:1. 1:2:1. So one by 4.
250, sir.
225.
225, sir.
225. Next, Kavya, rupees 900 into 2/4.
450.
Then Divya, rupees 900 into 1/4. 225. So there is a realization profit here because credit was more and debit was less. So we have got a balance of rupees 900. So between debit and credit difference is 900. The meaning of that is realization profit that has been divided among the partners in the ratio 1:2:1. Have a look at this. 1:2:1. This is the realization account part of it. Coming to the combined partners capital accounts, there are 3 partners. So I have opened 3 columns for each partner, 1 column. So we have to start with always opening balance brought down. That is the capital balances of the 3 partners. What is given in the balance sheet. Capitals of Ramya, Kavya and Divya all are on the liabilities side. Liability side means that comes to credit side by opening balance brought down. So 42,000, 35,000, 20,000. So first make an entry, then worry about transferring the amounts 42,000, 35,000, 20,000. So by balance brought down, liability side to credit side. Next, we have in the balance sheet reserve fund. So reserve fund is 8,000. That 8,000 we have to consider here and divide in 1:2:1 ratio. So by reserve fund, 1:2:1, it is divided by 4 every this one. So if you do that, 2,000, 4,000 and 2,000. So 2,000, 4,000 and 2,000 is the value. Next, we have to transfer the entries from realization account. So we have here by Ramya's capital account. Ramya has taken over furniture. It's called asset taken over 9,000. So this will come to the opposite side. Remember, by is there, it becomes 2. So 2 realization account. Out of this 3, asset taken over is only by Ramya, and Kavya has not taken anything, and Divya has not taken anything. So this entry will go to debit side there. Similarly, we have here Divya's capital account. Divya has taken over Vani's loan of rupees 5,000. So this is opposite entry again. By realization account, the entry will be by realization. The meaning will be liability taken over. Who has taken over? If you look at it, Divya has taken over. So other 2 partners has not taken anything, any liability. So for them, nothing to enter. Then we have one more, 2 partners capital accounts. We have divided the realization profit that we have to take it here for the entry. So realization profit, in the ratio whatever we have divided, 1:2:1. So after making the entry here, nothing is left. We have taken all. So we have to go for totaling the partner's capital account. So have a check. Ramya 44,225, Kavya 39,450, Divya 27,225. That to be taken to the debit side, and for balancing we have to go for. So Ramya 44,225 minus 9,000. Next, Kavya, debit value is nothing. So full 39,450. Then for Divya also same thing, 27,225, debit is nil. So we have balanced the partners' capital accounts and found what is the amount or the cash to be paid to partners. We have done that. It's a balance amount. That is difference between credit side and debit side is a balance amount. So that we have done it at present. So that will enter in the cash account further. So cash account, we have to start with always balance sheet value to balance brought down. Have a look at it. The cash value here is 15,000 in the balance sheet. That 15,000 will come here to opening balance brought down 15,000. Then almost all the transfer entries, wherever cash is there, we have to transfer to opposite side. So here we have by cash account. That account, that entry is for all assets realized. So this will be considered as 2 realization account, assets realized, amount 1,19,300. We have one more cash entry for liabilities and expenses paid. So we have paid 3 liabilities and 1 expenses. So that value we will take it to opposite side by realization account, liabilities and expenses paid. That amount is 32,400. So we had 2 entries, one by cash, one to cash that we have transferred. Next, we will move on to combined partners capital account. We have here 2 cash account. So all the 3 partners have a balance here. So I'll go for one by one. So first one, Ramya's capital account, value 35,225. Then second partners, Kavya's capital account, 39,450. Then Divya's capital account, 27,225. So we have transferred this entry also. This side we don't have, buy side, it's the credit side, we don't have any cash entry. Now we have to go for totaling the cash account. If both the sides same value comes, that means we have done it right. 1,34,300. Look at the credit side, total that side also. Whether we have same amount or not, you will come to know. So credit side also we are getting the same amount, 1,34,300.
Yes, sir.
Any doubts is there, you can ask me.